Imagine a freezing winter night in 1907 when America was emerging as the most powerful industrial economy on the planet, with its vast network of railroads, massive steel mills, and abundant flows of oil. Yet at that very moment, a terrifying financial panic struck, with no central bank or official lender of last resort stepping up to protect the system. Instead, one man stepped forward to hold the fate of the entire nation in his hands. That was J.P. Morgan, then 70 years old. He locked the doors of his private library on Madison Avenue, forcing the most powerful bank and trust company presidents in New York to stay through the long night until around 4:45 the next morning, so they would sign a pledge to pour tens of millions of dollars into rescuing the failing banking system. This story is not merely about the absence of an official bailout mechanism. It is a much deeper tale who truly holds the power of life and death in the defining moments of history. And why did a great nation accept living without a financial safety net for over 70 years, ever since the charter of the Second Bank of the United States expired before 1913? America had operated its financial system without a central bank since 1836. The system relied on state banks, national banks, and especially private clearinghouse associations, most notably the New York Clearinghouse Association, founded in 1853. Many times these very private mechanisms improvised skillfully, proving that the free market was capable of self-organizing emergency liquidity. Thanks to this, the American economy continued to grow robustly through the Civil War, through the wave of industrialization and railroad expansion, despite the recurring cyclical panics. But behind that resilient facade lay lingering questions that remain deeply relevant today. Who truly saved the failing banks before 1913? Why did a system without a lender of last resort survive for so long? And what rendered it powerless against the challenges of the early 20th century? Did the creation of the Federal Reserve in 1913 truly resolve the root problem of financial power, or did it merely shift that power from the hands of private elites on Wall Street to a hybrid public-private institution in Washington? This is the eternal tension resting deep within the nature of American politics. From the Jefferson-Jackson tradition, the people always feared concentrated financial power, whether in the hands of the federal government or a private money trust. Yet a modern economy demanded systemic stability. So who truly deserved to control the ability to create emergency liquidity during a crisis? The pure free market, a group of private bankers, or the democratic state? The trade-off between individual liberty and the need for collective stability shaped an entire epic chapter of the United States. To fully understand why J.P. Morgan was forced to play the role of a private central bank on that fateful night, we need to turn back time to the early days of the Republic. That was when the Founding Fathers intentionally designed a financial system without a central bank. Dear friends, if you are looking deeper into the historical lessons of American finance, please leave a like for this video and subscribe to the Financial State Secrets channel today so you do not miss the upcoming episodes. Together, we will explore this highly dramatic journey in the greatest detail. Thank you for being with us. From the very early days of its founding, America faced an alarmingly chaotic financial landscape. After gaining independence, the country was drowning in war debt, a chaotic currency system, and severe inflation caused by the disastrous devaluation of the continental currency. It was in this exact context that Alexander Hamilton, the first Secretary of the Treasury, presented a bold vision. He proposed establishing the first bank of the United States with a capital of $10 million, in which the government held a 20% stake. This bank was inspired by the Bank of England taking on the roles of issuing paper money, managing government deposits, providing credit, and strictly disciplining state banks by demanding the exchange of banknotes for physical gold and silver. The charter was granted in 1791, but it only lasted 20 years and was not renewed in 1811 because the Jeffersonian faction feared excessive federal power and simultaneously dreaded the formation of a financial aristocracy detached from the people. Following the War of 1812, financial chaos erupted once again. Congress was forced to create the Second Bank of the United States in 1816. This time, the bank operated more effectively, helping to curb inflation from the state banks. However, it quickly became the target of a populist movement. Andrew Jackson, a beloved hero of the people, viewed it as a tool serving the Eastern elites and foreign interests. The bank war reached its climax when Jackson vetoed the bill to renew the charter in 1832. By 1836, the charter officially expired. Jackson emerged victorious. He transferred public funds to favored state banks, inadvertently sparking a land bubble and a frenzy of speculation. The consequence was the Panic of 1837, one of the most severe depressions in American history at the time, with a massive wave of banks suspending cash payments in gold and silver. The Founding Fathers, along with the Jacksonian spirit, shared a profound philosophy: they must strictly limit concentrated power in the hands of the federal government. They believed in hard money, gold and silver, and the autonomy of the states, and were particularly fearful that any central financial institution could be exploited as a political tool or used to grant special privileges to the wealthy. For this very reason, the independent treasury system was purposefully designed. Martin Van Buren signed it into law in 1840, and it was later firmly re-established in 1846 under President Polk. Under this system, the government kept its money completely separate in sub-treasuries, absolutely refusing to deposit it in private banks. The objective was clear: to avoid corruption, to prevent state-backed credit inflation, and to create a distinct boundary between public funds and the private banking system. This was a conscious effort to balance power, entirely separating the national treasury from the vortex of private credit. Without a central bank, America naturally lacked an official lender of last resort. The currency became inelastic. National banknotes after 1863 had to be backed by government bonds. The reserves of local banks often pyramided upward to higher tiers, ultimately concentrating in New York. The clearinghouse associations initially only processed checks, but gradually evolved into a force of collective self-rescue during crises. Meanwhile, the independent treasury acted as a firewall, not allowing the government to arbitrarily pump money into the banking system. This design was no accident. It was built to protect political liberty and decentralization, two core values of the young American democracy. The leaders of that era were willing to accept the risk of periodic panics as long as they could prevent the threat of a state-sponsored money aristocracy. However, this very fear also reflected a profound tragedy of democracy: how to reconcile the desire for individual liberty with the need for stability in an increasingly complex economy. The old system helped America maintain a spirit of self-reliance, but it also sowed the seeds for limitations that history would later expose. And to fully understand how that system operated in reality over the following decades, let us observe together how it dealt with the real storms. When the system was put into actual practice, it demonstrated the incredible resilience of the spirit of self-organization. During normal days, clearinghouse associations in New York and many other cities processed interbank cash flows smoothly, keeping the economic machinery in constant motion. But it was during stormy times that they truly revealed their mettle. When panic struck, these associations quickly transformed themselves into underground emergency support institutions. They established specialized loan committees, requiring member banks to provide solid collateral such as securities or commercial paper. Afterward, they issued short-term loan certificates collectively guaranteed by the entire association. These certificates replaced actual cash in internal settlements, helping to release precious reserves to meet the withdrawal demands of depositors. Reasonable interest rates and service fees encouraged parties to repay quickly, maintaining the necessary discipline. This was a purely private sector innovation, requiring no intervention from any federal law. Let us look at real stories to see how effectively that mechanism operated. During the Panic of 1857, when the Ohio Life Insurance and Trust Company collapsed due to excessive speculation in railroads and land, the New York Clearinghouse promptly issued loan certificates preventing the fire from spreading and rescuing many other institutions. By 1873, the bankruptcy of J. Cook and Company, due to Northern Pacific Railroad bonds, dragged down more than 100 banks across the country. The New York Stock Exchange had to close for 10 consecutive days. Once again, the clearinghouse associations mobilized reserves from members, stabilizing the situation before the disaster became irreversible. The peak was the Panic of 1893, when approximately 575 banks temporarily suspended operations or failed completely, as recorded by Bradstreet's. The outflow of gold abroad due to silver purchase policies made the situation worse. Yet, associations in 73 cities coordinated to issue loan certificates, and in some places even temporarily suspended payments in precious metals to protect the system. Conversely, during the undercurrents of 1890 and 1884, the New York Clearinghouse operated excellently, keeping the number of failures to a minimum. These examples prove that when parties coordinate well, private mechanisms are fully capable of preventing contagion. Looking at the broader picture, the old system provided relative stability through many upheavals. Thanks to this, America could concentrate resources for a powerful industrialization process without needing a cumbersome state apparatus. Economic growth maintained an impressive momentum over decades, despite occasionally facing shocks. This mechanism protected the interests of strong banks, especially in the financial center of New York. While fostering the spirit of self-reliance that is the identity of the nation, it clearly reflected the American philosophy dispersing power and encouraging responsibility from both individuals and collectives in the private sector. However, alongside those achievements, cracks became increasingly visible. The mechanism operated on an improvised basis, depending entirely on the voluntary cooperation of powerful institutions. This easily led to a situation where some parties benefited without contributing proportionately, causing weaker banks to be easily excluded from rescue efforts. By the end of the 19th century, trust companies developed as a form of shadow banking, less bound by regulations than national banks. They were often not members of traditional clearinghouse associations, so they were easily cast aside when crises occurred. Furthermore, without a unified framework nationwide, each region had to fend for itself. The currency supply still lacked the flexibility to adapt to the seasonal demands of agriculture or sudden fluctuations. In the deepest dark side, the power to decide who received rescue lay in the hands of a key group of bankers in New York, the predecessors of the so-called money trust. The lack of transparency and democratic accountability here made many people uneasy. Some historians argue that this model was nearly successful on a modest scale, but as the economy became increasingly complex and tightly integrated with the world, its inherent limitations began to be dangerously exposed. It was these cracks, though hidden at first, that gradually accumulated and created pressure that could not be ignored. They would push the country into a dramatic period of transformation. The initial successes of the system gradually revealed its limits as the country entered a period of profound change. Industrialization took place at a dizzying pace, requiring enormous capital for expanding railroads, growing steel industries, and increasingly abundant flows of oil. The economy became ever more dependent on the short-term lending market, where loans backed by securities could fluctuate wildly in the blink of an eye. At the same time, trust companies emerged as an alternative investment channel, operating more flexibly, but remaining outside the control of traditional reserve and payment systems. Massive migration from rural to urban areas, rapid urbanization, and a widening wealth gap increased pressure on the entire financial structure, which was already fragile. Politically simmering discontent exploded into a powerful populist movement in the South and the West. People there viewed Eastern bankers as a foreign force, manipulating the nation's fate. William Jennings Bryan, with his Cross of Gold speech in 1896, ignited the flames of resistance, demanding the free coinage of silver to loosen the shackles of the gold standard. Fears of the money trust spread further after large-scale mergers. Most notably, the birth of the United States Steel Corporation in 1901 under the backing of Morgan. Those massive corporations did not just demonstrate economic power, but also stirred up fear about the concentration of power beyond the people's control. In that context, reform efforts repeatedly failed or were merely temporary. Many ideas about issuing money based on commercial paper instead of just government bonds were fiercely opposed by small independent banks and populist forces, fearing it would pave the way for easy credit and inflation. The independent treasury increasingly revealed clear weaknesses. When the budget had a surplus, it sucked cash out of circulation, creating deflationary pressure. Conversely, during a crisis, the government's demand for payment in precious metals worsened the scarcity. After a major panic, Congress passed the Aldrich-Vreeland Act of 1908, allowing groups of national banks to issue emergency currency based on commercial paper. This was only a temporary solution aimed at creating necessary flexibility. Simultaneously, the act established the National Monetary Commission led by Senator Nelson Aldrich, with a mission of deeply studying European central bank models to seek a long-term direction. Conflicts between factions and regions made the situation even more tense. The Northeast, with large banks and industries, craved a more stable system with abundant capital to support growth. Conversely, farmers and small banks in the South and West feared that Wall Street would dominate completely and that easy credit would lead to new bubbles. Progressives demanded stricter democratic control over the money power. These contradictions accumulated through every panic of increasing scale and severity. By the early 1900s, many began to realize that although clearinghouse associations or exceptional individual figures had many times rescued the situation, the old model was no longer capable of coping with a modern industrial economy, where risks could spread rapidly nationwide and even internationally. Relying on a single individual in life or death moments had become unsustainable, both politically and in terms of democratic principles. Those cracks could no longer be patched. They were about to push the country into a fateful crisis where every limitation of the old system would be tested to the limit. The pressures that had accumulated over many years finally exploded into an uncontrollable crisis. This was the Panic of 1907, also known as the Knickerbocker Crisis, the moment when the entire old system revealed its limitations. The environment at the time was extremely fragile. A mild recession was spreading, the San Francisco earthquake the previous year had drained capital, and the Bank of England raised interest rates, making international cash flows tight. The immediate trigger was the failure of a stock manipulation scheme involving the United Copper Company, backed by F. Augustus Heinze and Charles W. Morse. Confidence collapsed rapidly, and the panic began to spread from the Knickerbocker Trust Company, one of the 3 largest trust companies in New York. The story unfolded with an unpredictable, dramatic pace. On October 21, the National Bank of Commerce ceased its role as a clearing agent for Knickerbocker. Just one day later, on October 22, Knickerbocker was forced to close. Benjamin Strong, who would later become the first president of the Federal Reserve Bank of New York, was tasked by J.P. Morgan to examine the books. As a result, Morgan refused to provide an immediate bailout because he could not be certain of the institution's solvency. At that time, Morgan, a 70-year-old man with prestige and relationships spanning Wall Street, became the center of every coordinated effort. He convened emergency meetings in his private library. In a dramatic decision, he locked the front doors and kept the trust company presidents inside throughout the long night, refusing to let anyone leave until a concrete agreement was reached. The climax occurred around 4:45 on the morning of November 3. The exhausted financial leaders were forced to sign a pledge to contribute capital to rescue the Trust Company of America and several other institutions. Morgan did not stop there. He persuaded Treasury Secretary George Cortelyou under President Theodore Roosevelt to move public funds into New York banks, an action that clearly crossed the principles of the independent Treasury. To save the brokerage firm Moore and Schley, which held Tennessee coal and iron stock as collateral, Morgan arranged for the United States Steel Corporation, which he himself controlled, to acquire that stock. Roosevelt quickly approved, despite concerns about monopoly, a decision that was later heavily criticized for suspected favoritism. Meanwhile, the New York Clearing House also issued loan certificates on a large scale. In New York alone, these exceeded $110 million, contributing to hundreds of millions of dollars in cash substitute instruments across the nation. Behind these decisive actions were deep-rooted causes. The traditional clearing system did not cover trust companies, a form of shadow banking that was growing strongly. The lack of a unified national coordination mechanism, combined with a crisis scale that far exceeded the capacity for voluntary cooperation, nearly caused everything to collapse. Fortunately, the panic was controlled in time. The market gradually stabilized by the end of November. However, the price paid was extremely high. The public clearly witnessed the immense power resting in the hands of a group of private bankers, especially the so-called money trust, led by Morgan. The lack of transparency and democratic accountability sparked deep public outrage. That anger quickly led to the Peugeot Committee, conducting an investigation in 1912 and 1913, while strongly promoting institutional reforms. As early as 1908, the Aldrich Freeland Act and the National Monetary Commission were born as the first direct responses. That moment was not just the peak of a crisis, but a historical turning point. It exposed that no matter how strong the spirit of private self-reliance was, there were limits that a modern economy could not overcome without fundamental change. And from the ashes of shaken confidence, a new institution was about to be created to shape the financial future of America. From the ashes of shaken confidence during that crisis, a new institution gradually formed and permanently changed the national financial landscape. President Woodrow Wilson signed the Federal Reserve Act, creating a system of 12 regional banks and a board in Washington appointed by the president. Member banks owned shares, but real control remained in the hands of the state to a limited extent. The Federal Reserve was granted the power to issue flexible paper money discount commercial paper, and gradually became a sophisticated monetary policy tool. The role of the government shifted dramatically from a passive observer to the final guarantor for the stability of the entire system. That journey spanned many key milestones. As early as 1914, the Federal Reserve officially began operations. In 1933, the Banking Act established the Federal Deposit Insurance Corporation while separating commercial banking from investment banking. In 1935, another act continued to centralize power even further. After World War II, the Federal Reserve gradually asserted its relative independence, even though it still faced pressure from the political arena. The 1970s witnessed a period of stagflation that severely tested its operational capability. In 2008, the Federal Reserve and the Treasury had to intervene on an unprecedented scale. In 2010, the Dodd-Frank Act strengthened oversight. And even in recent incidents like 2023 with some regional banks, the Federal Reserve still quickly established emergency lending mechanisms to stabilize confidence. To clearly see the nature of this transformation, we need to objectively observe the two periods. The old system, from 1836 to 1913, possessed unique advantages. It brought local flexibility, encouraged a spirit of self-reliance and private sector coordination, and minimized moral hazard because there was no default state guarantee. However, the downsides were also very clear. Uneven support made many weaker banks easily abandoned. It lacked a unified national framework. It was easily influenced by personal judgment, and it was completely powerless against the scale of the modern economy. The result was recurring panics, sometimes leading to deep recessions. The real power lay on Wall Street, but it lacked legitimacy from a democratic perspective. Conversely, the new system after 1913 brought superior advantages. It provided liquidity in an organized manner, significantly reduced the frequency and intensity of bank panics, supported more stable growth over the long term, and possessed clearer public legitimacy despite still being a hybrid. Nevertheless, this system also contained its own risks: increased moral hazard with a too-big-to-fail mentality, the risk of politicized policy. The potential for creating bubbles or inflation due to easy credit and power still remained concentrated, although it now shifted to a combination of Washington and Wall Street. In other words, before 1913, bailouts were personal or private collective efforts with clear choices. After 1913, it became institutionalized broader, but also sparked expectations of protection from the state. The most profound change lay in the relationship between the citizen and the state. From the Jefferson-Jacksonian model that emphasized a minimal state where each individual and the market were responsible for themselves, we shifted to a model where the government, through the Federal Reserve and insurance agencies, became the final bearer of financial stability. The people were better protected against the risk of bank runs, but in return, had to accept deeper intervention in the credit sector, along with potential moral hazard. This is the classic trade-off between individual economic liberty and the need for collective stability, a topic that continues to spark heated debate in American society to this day. The lessons from that long journey do not just stop in the past. They remind us of the complex nature of financial power and the responsibility to protect the economy. And from that realization, we will enter the conclusion to draw deeper reflections for the present and the future. Throughout the long journey from the nation's founding to the present day, American financial history has delivered a profound lesson: no system is perfectly flawless. The private sector once proved its ability to organize highly effective emergency relief tools, from clearinghouse associations to the decisive role of Morgan in moments of peril. This confirms the intense vitality of civil society and the spirit of self-reliance that serves as the foundation of the nation. However, when the scale of the economy and the complexity of the financial system far exceed the capacity for voluntary coordination, a public institution or a hybrid between public and private becomes essential to maintain overall stability. The core issue is not whether to have a lender of last resort, but who holds the power to control that mechanism, through what democratic oversight measures, and what price we must pay in terms of moral hazard and the concentration of power. Looking at it in a balanced way, the creation of the Federal Reserve in 1913 was a logical step in the context of a modern economy. It has helped the country avoid repeating the devastating recessions that occurred in the past. Even so, the transfer of power from a group of private bankers who could act quickly but often lacked transparency to a new institution also carries its own risks. Such an institution is susceptible to political influence or creates an excessive reliance on state intervention. Both models, though stemming from different origins, private or public, harbor the potential for abuse of power. The difference lies only in the form of expression. Lessons from the past continue to echo in contemporary discussions. Major events in the 21st century show that the Federal Reserve still plays a pivotal role, sometimes having to significantly expand its scope of operations to stabilize the system. At the same time, they also stir skeptical voices regarding the necessity of a central bank. Recent bank failures remind us that even with a modern regulatory framework, mass deposit withdrawals can still occur when confidence is shaken, and the state remains the ultimate backstop. Debates surrounding regulations for digital assets, forms of shadow banking, and the level of independence of the Federal Reserve all revolve around the familiar question: who will step up to provide a bailout when financial institutions face difficulty? History teaches us that designing financial institutions always requires a fragile balance between economic stability, individual liberty, and democratic responsibility. Understanding this journey is not just about looking back at the past. It is the key for every citizen today to demand transparency, accountability, and better institutional designs for the future. The power to decide on rescuing the economy should not belong to any interest group, whether private financial elites or state agencies, but must always be placed under the control of firm and sustainable democratic principles. Be informed observers, because the financial future of this country ultimately remains in our own hands. Dear friends, if this journey of exploring American financial history today has brought you valuable reflections, please give the video a like and subscribe to the Financial State Secrets channel to join us in the upcoming episodes. Thank you for your support. We have many more valuable historical stories to share together.